right, so we're back in the next part of this series that's called Middle Class Millionaire Math, and we're discussing investments. Now, if you know nothing about investments and you're flat broke, or you know someone who's flat broke and knows nothing about investments, either you should definitely be paying attention to this video or you should be sending this entire series to them, all right? Now, at the end of this 10 to 15 minute video, I guarantee it, you're not going to be a millionaire, but you are going to have a brief overview to then research further into all these different asset classes. Now, most millionaires, before you throw in the towel, right? I want you to know something. Most millionaires are first generation. I think it's over 80%, according to this book called The Millionaire Next Door. Most millionaires are the first person ever in their family to become a millionaire. And this is how they did it. They accumulated and used all these different asset classes. So let's jump right into it. Cash. You make $1,000 a week, your bills are $900 a week, you have $100 left over, and if you go to the bank, you can ask for a crispy bill. That's just cash, right? Now, cash can also sit in a checking account, which then you can use on a debit card to move money around. Cash has a 0% yield, meaning it doesn't go up in value. Actually, it goes down in value. Over the last 50 or so years since the dollar was taken off the gold standard, inflation has eroded cash's value. A dollar back in 1971, I believe, is when it came off the gold standard. A dollar could get you a whole bunch of things. Nowadays, I bet you there's people who might not even pick up a dollar off the ground. That's how much it's been devalued, okay? So depreciated. Now, cash has a zero yield, right? And they're printing money. So why would you want to hold on to cash? So people who are smart with their money, they know they don't want to lose value with their money in cash as they print more money. They want to buy things that are going to ride up with the tide of inflation, all right? People, in the meantime, instead of keeping cash under your mattress, they'll put it in a savings account. It's like a restart fund. That's an emergency fund. That's where you're maybe waiting for the stock market to come down a little bit. You can keep your money in a savings account. Or you're waiting to buy a rental property, you keep your money in a savings account where it's getting a 3 or 3.5% return on your money. All right, something to think about. Savings accounts are typically free. If you have a bunch of money sitting in a checking account or in a jar somewhere, you might want to put it in a savings account, but you do you. Bonds. So the US government spends more money than it actually takes in on taxes. So it has to issue bonds, better known as an IOU. Your aunt gives you $100, you need a little bit of money, and she says, I'm not going to make you take out a loan for it, but pay me back. It's an IOU. Well, the government will make you pay a little bit of interest. They will pay you a little bit of interest, rather, on the money that you give them. They need money from you to pay their bills. So if you give them $1,000, they're going to give you $1,000 plus some interest in the long term. All right, here's two examples. The US Treasury prints out these bonds and they offer them to investors. Now, that's not just fancy guys in suits. That's you and me. We can buy a bond that's 10 years, meaning you can't really cash it in for 10 more years, and you can get 4.5% on your money back. That's pretty good. Or 30 years, you can lock up your money for 30 years and get a 5% return on interest. Now, you can get better returns in the stock market, but right now the stock market's been going up and down, and some people are thinking, hey, you know what? Bonds aren't a half bad idea right now, especially when you get older and you're relying on a fixed income and you can't take any risk. So that's how bonds work. They're IOUs. You give the government money, they pay their bills. They write you this IOU or a bond, treasury, and they pay you back that money with some interest on top. Annuities, very simple. People worry that they're gonna outlive their savings. They work 30, 40 years, they retire, and they collect Social Security, but it's typically not that much. But they have a little bit of money saved and they can tap into it whenever their car needs to be fixed or their roof needs to be repaired. But that typically is going to run out as well. So what people do is they get enrolled into an annuity. Long story short, this is the most basic way to understand it. You could pay $500 a month right now to then get $1,000 a month later when you retire. Now, that's very easy math there, but that is the idea. You pay money now into it, and then you get more money later when your expenses are more, and you're older, and you have a lot of medical bills, and you need something that's guaranteed. That's how an annuity works. You can contribute to it monthly when you're younger and up into your retirement, or sometimes people with a lot of money could put $1 million, $2 million lump sum up now, getting guaranteed money again later on in life that's more than that initial investment. That's the bare bones explanation of an annuity. Moving on to stocks. Pretty much everyone has heard of these. They go up, they go down, they go up again, right? Stock market gets about a 7 to 8% annual return. There are safer stocks, dividend stocks, right? There are growth stocks that don't really pay a dividend, and the company, instead of giving you little dividends, they reinvest that money into the company to just make it go up. The problem with the stock market are there are crashes, okay? They've happened many times over the last 100 or more years, all right? People have lost their shirts in the stock market. People have had to push off retiring, especially in 2008 or 9. When I first started at my job, I was hearing of guys that had to push off their retirement because the stock market was going down. And there are risks when it comes to really any of these assets, but with the stock market, there are crashes. But with crashes, there are opportunities. If you load up here on these lower areas, you do what's called dollar cost averaging. You buy when it's low and you let it ride up. It's a very common tactic that people use for investing. It's used with other asset classes as well. Something to think about. This is how people get rich. They take their cash and they got some money in savings. They put a little bit in bonds. Maybe they're not thinking an annuity, but they want to buy some stocks so they can get that 7, 8, maybe even 10% return on their money. So they shove some of this cash into stocks, all right? Now, real estate. This is going to be its own video, okay? But bare bones real estate investing. You buy a piece of property, you collect rent from all of the units, you take that money, pay off all the bills, you have a good accountant, you're going to have very legit and legal ways to pay very little or no taxes. Real estate is very tax friendly, but trust me, my friends, it is a massive headache. I've done it before with multiple properties, all right? I don't own them anymore. I may down the line in my video of just about real estate investing, I will get into that, all right? There's a lot that goes into it that I won't share here, but it comes with massive headaches, so please know that. Now, the return for real estate, we're talking 0% yield, 4 here, 7 to 10 here. It's really unlimited. I shouldn't say that, but it's very high. And a lot of it has to do with the tax benefits, okay? It's what's called a cap rate, a capitalization rate. The price you buy it at, plus the rent you can generate in the appreciation of the market over time. Real estate investors use that. It's called a cap rate. I'll get into that later. So a little bit about real estate. Being a business partner or being involved in a business. No, I don't mean a small business like you're your own painter or whatnot. But say, you and 3 other business partners, so 4 of you guys go into business together. 30% partner, 30%, 30%. All 3 of those people, they're actively involved. They're showing up to the store. They're showing up to the job site. They're materially involved in the business. They are not going to be getting the tax benefit of passive income because they are materially involved. They're going to be getting what's called earned income. But if you're a very small partner in it, say you fronted a lot of this money and you want to be a passive investor, you don't want to be banging hammers, you don't want to be dealing with clients, you just gave some money, you helped get the loan, you're a passive investor. You say you're a 10% owner right here in this green shaded area. Now you qualify for passive income, okay? It's taxed at a lower rate, but comes with its downfalls. You have a loss of control. These people outweigh your share and they're gonna overrule you with certain decisions, all right? Very complex. I'm just covering it as quickly as possible. There's a lot more that goes into that, and the tax code does change periodically, so that is being involved in a business as a partner. The returns on this are actually pretty much unlimited. If you have a business that just knocks it out of the park, your return could be unlimited. You could go 100% the first year, 300% the next year. You see these companies like Facebook, when they first started, it was just going up and up and up. Could go down too. Owning a business comes with a lot of risk and also a lot of headaches. Now, I'm gonna go to the other side. We're gonna talk the last two asset classes. We're gonna discuss precious metals now. Precious metals are a great hedge against inflation. As the government prints more and more money, as they have to issue more and more bonds, and the Federal Reserve has to print more and more cash, all of these just go up. Like they're pumping more money and the tide is coming in, all of these go up like a ship, all right? It's a great hedge against inflation. It can be gifted as inheritance, and that comes with tax benefits there. And you can put it into what's called an UGMA account, a gifting account for a minor, or grandkid, niece, nephew, family friend, anyone who's under 18. You can start an UGMA account and put gifts in there, okay? Very tax friendly. There's also something very special about gold, silver, and precious metals, something just holding on to it. I got a couple right here. I got a couple great pieces of silver I just love to hold on to. Even here's a very meaningful coin to me. It's about size of a nickel. It's called a silver half groat. It has the face of this king on it. For some reason, over time, people have just been attracted to silver, attracted to gold. There's something very special about it. So another asset class that people have made millions and millions of dollars on. And then I'll end with crypto. There's going to be more asset classes of this. You can get into mining, farming, refining, extracting materials from the earth. Won't even get into that. Truly, it's a little over my head, but we'll end off with crypto. Is this the future? And the price on the chart says that it is. And it's been, I didn't buy into the hype at first, and then I bought, and then I sold, and then I bought and sold. Had I just held it, my crypto portfolio would be insane. I first bought back in the first crypto craze when it was around 10,000 a Bitcoin. There's massive swings, absolutely massive swings. But if you dollar cost average DCA, like we said back here with stocks, people have done very well if they sold when it's high, bought when it's low, trim a little bit when it's high again, rebuy when it's low. Or sometimes people just buy when it's low and they just hold on to it. They are fully in on crypto and they've done very, very well. But with these crazy swings we see, there's a lot of risk there. So all of these come with their own risk. A lot of these have downside risks. A lot of these have headaches and liability. There's also the risk of doing nothing. And this is what I'm going to end off here. The risk of doing nothing, playing it safe. Holding all this cash, getting no money on it, massive risk to doing nothing. The government is printing money and you're gonna hold on to it. They are printing it. They are making more of it. They have printed, I don't even know how much they've printed since I started this video. I bet you it's a lot, okay? So doing nothing has its consequences as well. Doing something has its ups and its downside risks, something to consider. But I promise you right now, you are not going to get rich unless you start studying all of this. And the reason why I want to get rich isn't to hoard all my money and show it off and tell you, I told you so. It's so that I may not have to work 2 or 3 jobs. I might not have to take overtime. And when the time comes that I can retire at a decent retirement age, I can do so and feel comfortable. So I can also spend time with my loved ones, doing the things I love with this one life that I have. You have one life to live. You want to make the most of it. You have loved ones depending on you like I do, and it's very important that you know this stuff. No more excuses. Now we're going to end this video and go on to the next part of the series. Thank you so much. A lot of time goes into making these videos, but I created this channel to discuss all things economics and finance to help people just like you. So if you found this video helpful, please give it a like and subscribe to the channel for all my upcoming videos just like this.